Hey, what's going on, YouTube? And welcome back to Tech Conversations. As always, I am your host, Guillermo. And as always, I am not a financial expert nor licensed professional. If you plan on investing in the stock market, please consult with one first and invest at your own risk. So I hope you're all having a great day today. It is November 14th. Hope you're all having a great weekend so far. In today's video, I want to talk about selling put options on Robinhood. Selling puts on Robinhood is a really great way to generate some consistent income every single week. And in my opinion, it's one of the safer options trading strategies that there is out there. And so if you take a look here in the last week, I made over $1,100 in the last week, and half of that was from selling options, selling put options, and selling call options. I'll talk about selling covered calls in a different video. So before I get into talking about selling put options on Robinhood, just a reminder that I will be doing a giveaway once I reach 20,000 subscribers. If you'd like to enter that giveaway, all you need to do is hit the like button down below. Make sure you're subscribed to this channel and let me know in the comment section below what your favorite stock in the stock market is right now. Let's talk about selling put options on Robinhood. So the first thing that you want to do is firstly find a stock that has a great upward trend, great growth, and it's just going in an upwards direction. Okay. Secondly, find a stock that you would not mind owning 100 shares of, and also that you can afford to own 100 shares of. And thirdly, and this is more optional, but you want to find a stock that has dividends, because in the scenario where you are forced to purchase 100 shares of this stock, you can at least sit there and collect dividends as well. And so one of my favorite stocks to sell put options with is Microsoft. So let's go over to Microsoft and let's figure out how selling put options works. So here is Microsoft. I only have 5 shares, but I have sold a lot of puts on Microsoft. I've also owned 100 shares of Microsoft before. So in the last 5 years, we can see here Microsoft is up almost 300%. That's about a 60% gain every single year. So that definitely checks off our first checklist, which is a stock with good upward trend, great growth. Would I mind owning 100 shares of Microsoft? Absolutely not. It's a great company, a bunch of great products, and I just expect it to continue to grow. And lastly, like I mentioned, this is more optional, but does Microsoft have dividends? Yes, it does. And in fact, it has a dividend yield of 0.95%. So again, in the scenario where you are forced to purchase 100 shares, you can at least collect dividends as well while you're holding those 100 shares. And so this is Microsoft. Let's go over to Microsoft's options and talk about how to sell put options on Robinhood here. So here are the options for Microsoft. All you need to do is click on this button and it'll take you to the options for Microsoft. So here they are. And remember, you can buy options and you can sell options. We're not going to focus on buying options today. We're going to be the seller instead. Okay, remember, the first thing you want to take a look at here is what expiration date do you want to choose for your contract. So right now it's set to November 20th. You can choose an expiration date that's farther out. I like to do the closest one to whatever date it is because generally speaking, those premiums will be larger. Now, we're not going to focus on selling call options in this video. I will make a separate video for that. So let's go over to selling puts. Okay, so you click on this little put button here and it'll take you to the put options for Microsoft. So Microsoft right now is at $216.50. And so here's the way this is going to work, guys. We're going to sell a put, and here is the strike price, which is a very important part of this. So the strike price that you choose here is going to be the price at which you potentially might be forced to purchase 100 shares of the stock. And so let me just throw out an example. Let's say I chose this contract right here. Let's say I wanted to sell this put right here. Well, what's going to happen is if at the end of the day on the expiration date here, so November 20th, if Microsoft, the share price of Microsoft falls below this strike price that I chose, you're going to be forced to purchase 100 shares of that stock. right? So if November 20th comes and the market day ends and Microsoft share price is below 210, then guess what? You're going to be forced to purchase 100 shares of Microsoft at $210 a share. But what do you get in return for selling this put option? Well, you receive a premium. You receive money for selling this put. So how much money do you receive? You're going to receive whatever is under the price here. So for this one, it's $1.16. Now keep in mind, each one of these contracts controls 100 shares. And so this is the price that they're going to pay you per share. And since there's 100 shares, we need to multiply this by 100. So if I were to sell this put right now, I would receive $116. And again, if Microsoft falls below 210, when November 20th comes, then you're going to be forced to purchase 100 shares at that strike price. If Microsoft does not go under that strike price, though, if it stays above 210, then you keep the $116. Okay, and in fact, you keep the premium no matter what, whether it falls below or it doesn't, right? The only difference being that, again, if it falls below this, you're going to be forced to purchase 100 shares. If not, then you just made $116. You can sell a put the next week again. Now, how does this work? How do you make money here? Well, we have to take a look at the Greeks here for a second. So the Greeks here, right, there's 5 of them. You need to multiply them by 100 because, again, this tells you the value per share, and each one of these contracts controls 100 shares. And so if we multiply all of these by 100, we will get the actual true value for this contract. And so there's a couple of Greeks here that we need to pay attention to, and in particular, delta, theta, and vega. So when it comes to delta, if we multiply this by 100, right, it's going to be negative 22.22. And that's going to be a dollar amount. So negative $22.22. So what that means is that when the share price of Microsoft goes up $1, the value of this contract is going to lose $22.22, which means that you just made $22.22. That would be your total return then. Of course, you need to add gamma after that to get your new delta. So delta does change with respect to gamma. But let's just not focus on that. Now, if the share price of Microsoft goes down by $1, though, then the price of the contract will go up by $22.22. And that means you're going to be down $22.22. Right, so selling a put is a bullish strategy. You do want the stock to go up. Now, the other big Greek here is theta, right? So what I like about selling options is that time is working for you. Theta is going to tell you how much the value of this contract goes down by every single day. And so theta here, remember we multiply this by 100, would be negative $18.89. That means that in a day, right, and just because of time, this contract is going to lose $18.89 in value, which means you, since you just sold this put option, are going to make $18.89. That's what theta means. And then there's vega. So vega is related to implied volatility. So what this means is that every time there's a 1% change in implied volatility, the value of this contract will either go down or up by $8.93. Because remember, we have to multiply this by 100 first. So that'd be $8.93. So if implied volatility goes up by 1%, the value of this contract will go up by $8.93. However, if implied volatility goes down by 1%, the value of this contract will go down by $8.93. Okay, so remember, delta is how much this is going to go down or up by with a $1 change in the share price. Theta is how much the value of this contract loses every day just because of time decay. And keep in mind, theta does get bigger the closer it gets to the expiration date. And then vega, again, is how much the value of this contract goes up or down by with a 1% change in implied volatility. Okay, so that's how selling a put option works, right? You're going to choose a strike price that you're comfortable purchasing the 100 shares at, and you're going to get paid to do so, potentially. if the share price does fall below the strike price. Again, if it doesn't fall below the strike price, good job. You just made whatever the premium is, and you can continue to sell put options the following week. Now, another thing that I do want to mention here quickly that I get all the time is you can close out of these options, put options, early. Okay, you don't have to wait until the expiration date. So for example, I have a put here that I sold on NEO stock. This expires on November 20th, which is this Friday. Okay, I don't actually have to wait till Friday to get out of this contract. Okay, I can close out of this anytime that I want. Now, keep in mind, if you're doing it on the same day that you sold to open it, that is going to be a day trade. Okay, so just keep that in mind. But I can get out of this put option anytime I want. So I sold this put on Friday, and this expires on next Friday, right? I could close out of this on Monday if I wanted to. And the way you do that, right, is you just got to do the opposite transaction of what you did. So if you sold a put, in order to close that, you're going to have to buy that exact same put, exact same expiration date, and exact same strike price. So if I sold a put at a $35 strike price, expiring on November 20th, if I wanted to close out of this, I would buy a put at a $35 strike price expiring on November 20th. Now the cool thing is, if you're on desktop, it actually already has this cool thing that just does it for you. So since I sold this put, I would buy to close it. If I had bought the put, I would sell to open. So I would buy to close. You'd put in as many contracts as you have that you want to close. So I only have one, so I would buy to close one. Now keep in mind here, I'm going to be paying $103 because that is how much the value of this contract is right now. And since when I sold this put, I only received $48, but now I'm paying $103, I would lose $55 overall for this entire trade. So keep in mind that total return shows you how much you've made or lost so far in case you're trying to close out of that options trade. Okay, so keep that in mind. You can sell put options and you can close them out or get out of them before the expiration date. You don't actually have to wait until the expiration date. You can close out of it anytime before. So anyways, guys, that is how you sell put options. Again, a very consistent way to generate passive income every single week. I've been doing it for such a long time. It's never failed me, and I've never really gotten into much trouble because, again, I'm always choosing stocks with great potential growth, great upward trend. A lot of the times they do offer dividends as well. And so in the next video, I'll show you what you do after you are assigned 100 shares, which is going to involve selling covered calls. So if you guys have any questions about anything that I just mentioned, feel free to leave them in the comments section below, guys. That is how you sell put options on Robinhood. And remember, guys, to join the Discord, link to it is in the description below. If any of you plan on using Robinhood in the future, feel free to use my referral link, which is also in the description below. If you sign up using my referral link, both you and I will receive one free stock, which is free money for both of us. So let's help each other out, guys. And as always, I hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.